Good evening, everyone. On behalf of Trust Mutual Fund, I would like to extend a warm welcome to all of you. My name is Pooja, and I'm part of product team here at Trust Mutual Fund. It's a pleasure to connect with you all. Today's webinar will focus the topic the growth and valuation of Indian markets, which is a key concern for many investors, especially given the current economic environment and evolving market dynamics. We are thrilled to have with us two highly experienced experts who will be sharing their insights on this subject. Mr. Mihir Vora, Chief Investment Officer of Trust AMC, brings over 3 decades of experience in investment management. Mihir has an impressive track record, having worked as a Senior Director and CIO at Max Life Insurance, where he managed AUM of 1.3 lakh crore. Additionally, Mihir has held senior positions at some of the most prestigious financial institutions, including Abu Dhabi Investment Authority, HSBC Mutual Fund, ICICI Prudential Mutual Fund, and SBI Mutual Fund. His deep understanding of market dynamics makes him one of the leading voices in investment management today. We also have Mr. Aakash Manghani, Fund Manager Equity at Trust AMC. He is another key expert with over 14 years of experience in fund management and equity research. Aakash has previously served as a fund manager at ICICI Life Insurance, where he managed an AUM of 7,000 crore. We would be addressing your questions at the end of this session, so kindly drop your questions in the Q&A section. So now I invite Mr. Mihir Vora to kick off the today's session. Over to you, Mihir.
Thank you, Pooja. Good afternoon, everybody. Welcome. And it's a pleasure to address this August audience. So we will talk about the markets and valuations, growth, etc. But first of all, let me kind of paint a picture of the overall market backdrop, both globally as well as locally. So 2004 has been a great year for Indian equities, with handsome returns across most sectors and indices. And the good part is that this has been driven by robust profit growth for corporates across the market cap spectrum. So while indices have moved up, valuations have not necessarily increased because profits have almost increased proportionally. Most global central banks, with the US Federal Reserve at the forefront, have pivoted towards a monetary easing cycle. And this is not in response to any crisis like COVID or the global financial crisis, but just to normalize the post-COVID stimulus and then the tightening that we saw. So this moderation in interest rates, which is likely in the next 12 months, both in India as well as in the global system, implies a favorable environment for risk assets like equities. I think the most wonderful part of the market has been that the movement has been across sectors and it's been very broad-based. So just to give you some examples, year to date, that is calendar year to date, while the Nifty 50 is up a decent 11%, and of course in 1 year it's up about 24%, the Nifty 500 is up 16% year to date against 11 of the Nifty 50. The Nifty Midcap 150 is up 21%, and the Nifty Small Cap Index is up about 24% on a year-to-date basis. And on a 1 year basis, of course, the Small Cap Index is up almost 39%. So across the sector, across market caps, the markets have done well. For example, defense is up 89% on a 1 year basis, 50% year-to-date. Pharma is up 32% year-to-date. Auto is up 27% year-to-date. So it's been a very healthy, broad-based, rally in the markets, and this has been well supported by earnings. What we have seen is, of course, from time to time, if you see, we had events like the general elections. Then we have the US elections, which also created some uncertainty. We had the Japanese yen strengthening, which led to some kind of a risk-off environment in a couple of months ago. But all this has been very well absorbed by the Indian markets, and equity investors in India continue to pour money. In fact, as we speak, we've just got the mutual fund data for the month of October, and net equity inflows for the month of October have been 41,000 crores, the highest ever. So the India story in the minds of the domestic investor continues to be robust, and we are seeing record flows from the Indian investor. So that actually is one of the reasons why, in spite of FII outflows in the last 1 or 2 months, we have seen the markets actually continue to get supported, and this is purely on the basis of mutual fund flows, insurance flows, NPS flows, EPF flows. So there are so many, different places from which domestic money is supporting the market. And this just shows that there is an underlying bullishness in the retail investor sentiment in India. Uh, the US elections, of course, is past us. And in the long term, I think Trump government is beneficial for India. In the short term, there might be various pluses and minuses. We'll discuss that in detail later. But now it's back to business, and company-specific fundamentals will drive stocks. And we've seen that in the September quarter numbers. The market is behaving quite rationally. It does not look like a bubble situation. Good results are being rewarded and bad results are being punished. For example, many sectors like chemicals, some of the banks, finance companies, IT have corrected significantly in the past 24 months and created new leaders like capital goods, auto, real estate, defense, power segments. So while the indices are at near all-time highs, not all the stocks and sectors at highs, which is basically a healthy churn that is happening in the market. The Indian markets remain vibrant, and that's not without reason. India's medium-term prospect stands out really well in the global landscape. India's position as the fastest growing large economy in the world is not going to be challenged in the foreseeable future because of our demographics. We are supported by our demographics, our consumption strength, savings, and public sector plus private sector investments, and a strong banking system. The Indian economy combines robust growth with prudent macroeconomic management and fiscal policy, stable inflation, and a conducive investment environment. If I talk about risk factors, I think inflation in the US can be a risk factor. If it is higher than expected, then you might see some of the rate cut expectations being pushed back. But that's a risk that that's probably going to create some volatility, but nothing structurally for India. Middle East and the Ukraine war continue to be uncertain factors. You don't know what's going to happen in Israel, etc. But so far, commodities which basically we should be concerned with are holding on quite well. In fact, 5 years ago, 10 years ago, if such uncertainty was there, such wars were going on, oil prices would have spiked up dramatically and damaged India. But this time, that's not happening because probably China is slowing down, and that's the biggest consumer. So because of all these, macroeconomic factors, balance of payment, strong banking system, India will remain positive on the India economy and the markets. Overall, we expect about 7% GDP growth rate for the next year, 10 to 15% earnings growth for the large caps, and 15 to 20 plus % for mid cap and small caps for the next couple of years. And with a PE of about 20 on a 1 year forward basis for the Nifty 50 and about 21 for Nifty small caps, the risk returns are quite okay, in the sense I would say large cap as well as small caps offer good opportunities. Of course, the kind of returns that we have expected, I have actually generated in the last 1, 3, and 5 years may not be the norm. But still, if you look at a longer term view, equities will continue to be the most promising asset class for the long term. So, I think we are starting off, ending the year on a good note. The next year also looks fine. I don't see any major challenges. There were some concerns on consumption, but in the last few weeks, we are getting some indications that even rural demand is coming back gradually, which was a bit of a drag for the last couple of years. Urban demand, on the other hand, which was supporting the economy, is probably slowing down a bit. So we kind of have a balance there, but it's too early to say. I think with the festive season now behind us and the harvesting season start, I think we should wait for more data points and make sure that we get the consumption theme right. So I think what we are doing is we are sticking to our broad thesis, which is that we are basically more positive about domestic economy than the global economy. So we are sticking to our 3 or 4 main themes that we talked about, which is consumption, especially premium consumption, savings and financial savings. We are still bullish on physical asset creation as a theme, which means real estate, infrastructure, manufacturing, power, capital goods, defense, those kind of names. And we also continue to stock pick on the new economy stocks, which are basically your, the new, the companies which are using technology, etc., to drive a business and disrupt existing business models. I think those are the themes we've been talking about since the beginning, since we launched our flexi cap fund. That was the theme in our small cap fund also. That is the theme that we are following. So I think the domestic theme continues to be a very strong preference for us. We are basically likely to continue to be underweight on the global themes like commodities, energy, oil and gas, Even locally, I think cement sector probably will be underweight on. IT, the large cap IT especially, is something that we are not that positive on. Though with now Trump coming in, we are incrementally getting more positive because he's talking about tax cuts. He's talking about more corporate investments in the US, which means that IT spending might actually pick up. So we are less negative on IT compared to before, and we've added a little bit of a position on that. Mid cap IT, we are still positive, lot of scope for stock picking, but in general, all the global commodities and energy, etc., we continue to be underweight on. So that's basically the global and local economic macroeconomic backdrop that I wanted to start with. I'll share my screen. Uh, I just try to run you through the overall valuation situation in the market because people keep talking about the fact that index market has gone up so much. Is it expensive, etc.? So let's try to see some numbers. So first of all, let me start with the valuations and the absolute index levels. So this is the Nifty over the last about 5 years. The red line is the absolute Nifty level. I've just rebased it to 100 starting from 2019. So if you see, this is where the pre-COVID level was. So this is 2019 and this is when the COVID crisis stuck. So if you look at how much the Nifty is up, it's about 100% up. The Nifty has basically doubled from the pre-COVID levels, 98% from here to here, right? But what's happening to Nifty price to earnings ratios 1 year forward? It is at the same level as what it was pre-COVID. Why is that? What is price to earnings? It's basically the Nifty level divided by the earnings. The Nifty has doubled, but the ratios remain the same, which means that earnings actually have doubled in line with the Nifty. Let's look at the NSE 500. Similar story here. NSE 500, which is the broader index, has almost gone up by 128% since pre-COVID, but the PE ratio remains the same today as pre-COVID levels. The Nifty 500 is up 128%, which means earnings for the broader market are actually up by 128% since the pre-COVID levels. Let's look at the other index, which is the small cap index. Small cap index earnings have actually grown faster, and the index from the pre-COVID levels is up 235%. And the PE has increased by 30%, which means the PE was about 20 pre-COVID. Now it is at 27. But that is because the market has seen much faster growth in earnings in the small caps compared to the large caps. So there is a re-rating of the small caps that has happened. But again, the re-rating has happened not without reason. So if you look at the overall trend, as I mentioned in the beginning, that the markets are behaving quite rationally. Good results are being appreciated and stock prices are going up because of good results. And bad results are also being used to punish the stocks, and stocks are actually going down. So there's a very rational behavior happening in the markets across the board, whether it is large cap, mid cap, or small cap. So I am not of the view that we are in some kind of a absolutely irrational bubble because the numbers are not carrying it out. And if you say the Nifty is 50 is just the large cap, we saw the numbers for the Nifty 500, which is the broader market, similar trends. So I think the markets are still in a good growth zone, not in a bubble territory. The other thing that we very closely monitor is how estimates for earnings are going up or down. So let me just explain with one year. For example, for FY financial year 26, for example, we had a certain estimate of the EPS, say, and in 2023, people were expecting a EPS of 1,200 rupees for the Nifty 50. And that estimate remained more or less constant. In fact, it went up a bit. In the last few months, in the last few weeks, I would say, there have been some disappointments in the results, and the estimates for FY26, which is the next year, has been cut by about 3%. What is the market expecting? The market is expecting EPS growth of 15% for FY25, then 14%, and then 10%. So about 12% earnings growth for the next couple of years, which is fine. Little bit of downgrade in the broader indices. I don't think this is anything to worry about because the Nifty 50 actually has become a very global facing index. Let me break it up for you. About 35 to 40% of the Nifty 50 is financials, and financials are actually a reflection of the underlying economy. So let's put that aside. But apart from that, you have about 10 to 15% in energy, oil and gas. You have about 15 to 16% in IT. You have pharma. You have metals. You have other chemicals, etc. So lot of the weightage of the Nifty is actually globally facing, is global in nature, impacted by global cycles. And we, as I said, the global economy has been slowing down, especially Europe and China, and global commodities, etc., have seen downgrade. So most of the downgrades in the Nifty that you saw are actually because of all these global sectors. Okay, so this is one thing to bear in mind. But even after the downgrades, we are still expecting 10 to 15% growth in the Nifty earnings for the next couple of years. The situation is different for the wider market. The wider market actually is seeing upgrades. And the growth rates that you're seeing for the wider market are also higher. This is the NSE 500. Almost 20% CAGR for the next couple of years. And if you see the small cap index, it is even sharper. In fact, the small cap index has seen upgrades in the last few weeks. And the growth rates are also higher than the, much higher than Nifty, almost 20%. So this is all to re-emphasize the fact that the wider market and the domestic economy facing sectors and stocks are actually doing much better than the global economy linked face stocks. So if you look at the summary, if you look at the next couple of years, these are calendar years we are talking about. The EPS growth for the Nifty 50 for the next couple of years is about 12%. For the 500 is about 13%. For the mid cap is 24%. The small cap is 21%. The PE is higher, a bit higher for the mid cap, reasonable for the small cap and the large caps. So the PEG ratio that we typically look at just to strike a balance between growth and valuations is fine. I think we don't need to worry about valuations, frankly speaking. All we need to make sure is that we continue on the current growth path that the economy is paving at. So that was on the market valuations and growth part. Let me also touch upon our flagship fund, which is the Flexi Cap Fund. Because that's where most of the investors have put money. Of course, we got a lot of money in the small cap fund, but that's still in the process of being deployed. The Trust Flexi Cap Fund, we had said that we'll stick to about 60 stocks. We are very close to 60 stocks. We had said that we'll run it in a market cap agnostic way. We will not stick to the benchmark necessarily. Of course, we can stick to the benchmark if we have the view. But in general, we are agnostic of the large, mid, small cap exposure. We will basically put money wherever there is the maximum opportunity to make money. So the Nifty 500 is the benchmark for the Flexi Cap Fund, and it has a small cap weightage of 11%. In the fund, we have a small cap weightage of almost 32 to 33%. The mid cap in the benchmark is 18%. We have about 22%. Large cap is at 70%. We have about 38%. So you can see very clearly, we are running the fund exactly as we promised, which is in a completely flexible market cap, flexi cap way. The top 20 holdings, I will not spend too much time on, but this may be more interesting for you. Within the small caps and mid caps, these are our top holdings, the top mid caps and the top small caps. And as you can see, we have a distinct bias towards growth at reasonable valuations with terminal value. If you remember, that's our philosophy for investments. So we are running the portfolio exactly as per our style, which is of growth investing at reasonable valuations. So all the stocks that you can see in the mid caps and small caps are basically growth stocks, and we are trying to make sure that we buy them at reasonable valuations. Sector-wise, we are overweight on pharmaceuticals and healthcare, including hospitals and medical services, capital goods, consumer services, and consumer durables. And we are underweight on auto components, and all the metals and the commodity linked stocks. So these are our top underweights and overweights. And you can see that we've been managing the portfolio quite dynamically. So depending on the opportunities available, we have been moving the portfolio. Though our philosophy is to buy and hold, but if there are alternate opportunities available, or if there are opportunities to book profits because of irrational market behavior, we have been quite proactively doing the same. Proof of the pudding is in the eating. We have outperformed the benchmark by a handsome amount. The annualized returns, of course. So essentially, we believe that Indian markets continue to offer good opportunities. There is good growth underlying across market segments, market cap segments, across sectors. And we believe that the style of growth at reasonable valuations and terminal value investing will continue to add value to the investor's portfolio. So that's a brief from my side. Happy to take questions. Aakash is also here with us. So if you have any questions or queries, more than happy to take that.
Yeah, thank you, Mihir. We have two questions. One is, what is the cash level on which mutual funds are sitting on?
I would not have the aggregate number for all mutual funds, but we are typically fully invested most of the time. So our cash levels are typically running between 3% to 8-9% maximum.
And second question is, how much money has been invested out of the total money collected in small cap NFO?
So we have
Yeah.
actively started deploying money, and we had promised in the NFO for the small cap that we will deploy the money within 2 to 4 weeks, and we are well on track to do that.
Okay, that was the second question actually. By what time do you think you will deploy 100% of total money collected during NFO? A little bit more on IT and BFSI sector.
Sure. So in IT, I think I touched upon it a little bit. But Aakash, do you want to elaborate a bit more on the mid cap versus large cap debate in the IT sector?
Yeah, hi. I hope I'm audible.
Yes.
Okay. So on IT, what's happening is that 70-80% of the revenue that IT companies deliver is out of what they sell in the US. US economy actually has been holding up quite well. People were anticipating maybe 3-4 quarters back that US would go into a somewhat of a big slowdown, but that's not happened. The good thing is that we're getting to see decent corporate results come out of the US economy. Most of the large IT spenders, be it banks, be it healthcare, be it retail, or even manufacturing linked companies, have been reporting decent growth, and they've talked about not much curtailment on IT spends. So what we've seen in the last 12 to 18 months is that people have not shied away from IT spends, but the nature of spends has changed more from, change the business to run the business. So so-called discretionary spends, which involve spends around cloud or changing the system to more digital, they have reduced. But interestingly, the outlook for calendar year 2025 is quite optimistic. So a lot of the mid-cap IT companies like Persistent or Coforge, for example, they are reporting pretty strong commentary on what their clients are looking at. So here again, being small and nimble and agile is benefiting some of these mid-cap IT companies. Their revenues are in the vicinity of $1 to $2 billion. They have ended up growing much faster than the overall IT services market. The IT services market is growing at about 2 to 3 percentage points as of now. Historically, it's grown at about 4%. Indian IT outsourcers have gained market share over the last 5 years, 10 years, 15 years. But within that, the niche mid-cap IT companies who are catering to more of cloud adoption, discretionary spend, they are actually doing much better. So the outlook for IT for next year is actually quite decent. And I think some of these niche mid-cap IT companies would continue to do well. Valuations are quite steep vis-a-vis what they used to be pre-COVID. But I think most large companies across the world are saying that the technology intensity in the world has increased dramatically. We saw a sharp J curve in 2021-22 coming out of COVID, and that subsided to a certain extent in 2023. But I think that will pick up starting 2025. And given that the uncertainty around the US elections, who will form the government or things like that has now gone out. And with the Trump administration talking about pretty aggressive tax cuts, if that were to happen, that leaves companies a lot of cash on their hands. And they would up the ante on IT spends, I think, dramatically, maybe second half of 2025 calendar year. So we are pretty positive on IT, and but we'll keep monitoring what companies are saying, what their commentary is. Narrative needs to get corroborated with earnings. So that's on IT. Mihir, I'll probably let you add on BFSI.
Sure. So on BFSI, what we have been saying is that there are within the sector there are lenders and there are non-lenders. And while we are positive on the lenders means banks, NBFCs, private sector banks, and NBFCs. So on the lenders, they are a reflection of the economy, and we are positive, especially in the larger lenders. We are kind of avoiding the microfinance and unsecured lending players. So they should grow decently, and valuations are on our side. So that's a decent place to be in now. And valuations have corrected because the sector has underperformed for almost a year and a half. So, but the non-lenders are where the larger excitement is. And by non-lenders means we basically are talking about all the companies and segments which are catering to savings, channelizing savings into the financial system. So financialization of savings is a big thing that we have been talking about ever since we did the FlexiCap IPO. And so the financialization savings essentially incorporates all the segments like insurance, broking, asset management, wealth management, capital markets, then you can say depositories, RNT agents, mutual fund distributors. So all of these basically are one way or another helping investors put money into the various savings options available, whether it's insurance, asset management, insurance, mutual funds, PMS, AIF, whatever. So that segment will actually grow even faster for the long term compared to the lenders. So we are positive on that segment, even more than the banking segment. And that's also reflected in our portfolio. We are actually a little underweight on the banking and quite overweight on the basically non-lenders as we speak.
Thanks, Aakash. Thanks, Mihir. We have one more question. Where you see the base of Nifty or markets?
Base, I think, that's more of a technical question. But as we just discussed, valuations are on our side. And if the growth continues the way it is projected, then I think we should be in for good times. My basic thesis is that whether it's Trump or even if it was the Democrats which came to power, essentially the way the US debt situation is, they have no choice but to keep printing dollars, which means that ultimately they will have to keep the financial system pumped up with a lot of liquidity. So inherently globally, so temporarily while the dollar is strengthening and you are seeing risk of trade, but that's not sustainable. they will have to basically cut interest rates faster than expected, and they'll have to basically keep printing money, which is good for equity assets and even other assets like gold, real estate, etc.
So next question is about Trump only. After Trump winning, is there any negative impact on renewable stocks?
I would not think so because think see earlier there used to be a lot of dependence on government policy for renewable stocks because there was a lot of subsidy element, etc. But now, especially in solar and battery, solar, you can say power generation and battery storage, the costs have now come down dramatically. So there is no longer that much dependent on subsidies, frankly speaking, for the renewable space. So, for example, Elon Musk, who's now the blue-eyed boy of Trump, essentially all his business is based on renewables, right? Whether it's Tesla or the solar or the battery grid that he's creating, everything depends on renewables. So I don't think there'll be any negative policy-wise. As far as renewables is concerned, the only positive that can happen in the energy space is that Trump will now go for more oil drilling in the US, which can actually mean positive for a lot of pipe companies and ancillary companies which are supporting oil drilling, which was not being encouraged. This thing. So we are actually going to see a lot of investment boom in the US, which actually can be positive for India because I think many people have not noticed, but one of the fastest growing exports from India is actually machinery and capital goods. And if US goes for an investment cycle, then this can actually accelerate, which is good for India.
Yeah, quickly, if I may add, most of the renewable stocks that we have exposure to in India to invest in, not only our fund, but generally, they are mostly catering to the India story. And the government has highlighted time and again the kind of shift they want to make in our energy consumption, moving away from fossil fuels to renewables, primarily wind and solar. And that trend is irreversible. It's a structural mega trend, which is not here for the next 2, 3, 4 years, but probably for the next 10 to 20 years, where solar and wind will take away probably 40-50% of incremental sort of deployment, which used to be maybe 10-15% about 4-5 years back, but 40-50% of incremental energy deployment will be towards renewables. So I think that's a big irreversible trend, and US will do what they have to do, but in Mihir highlighted, I don't think that's going to get impacted. But Indian companies should have a very high runway for growth.
So next question is about our views on geopolitical stress and war escalations.
So I think with Trump having come in, probably his bias would be to wrap up the tensions as fast as possible. He's never been a big fan of expansionist or interventionist policies by the US. So it can only de-escalate from here, frankly speaking. He's a businessman. He's a practical guy. So I think hopefully things will be less tense than what it was in the past few years. And in any case, the markets have been surprisingly resilient globally, in spite of all these wars, Ukraine, Middle East, and then now the situation in Israel, etc. In spite of all that, oil prices have not really shot up, and I think the biggest reason for that is China is slowing down dramatically, and in spite of the Chinese government stimulus, the markets and the economy is not really picking up. So, with the biggest consumer in the world not growing fast enough, there is a cap on commodity prices, which is good for India.
We have one more question. What is reindustrialization in USA means to India and DXY view?
So I think I briefly touched upon it. With Trump coming in, you're right that he's going to basically make in America, so to say, the equivalent of make in India, because the US manufacturing base has really been hollowed out, and all the manufacturing has gone to China, and they now realize that it's strategically very, very, very risky to depend so much on China for so many crucial things, for technology components, for pharmaceuticals, for energy components, you name it, everything is now made in China, and that's very risky. Reindustrialization will happen because of a couple of things. One is because he's talking about tax cuts, which means corporates themselves, of course, will have a lot of incentive to invest more now because of tax cuts and making it more attractive to invest in the US. He's also talking about tariff barriers, which makes it more expensive to import and again more encouraging industry to invest in the US. For India, it means a couple of positives. There can be some negatives also because Trump has this perception that we are very protectionist. So he's not very happy with India on that. There might be specific industries where there might be, he may talk about further squeeze. But in general, I think I mentioned that capital goods and machinery exports from India have been going up. And that's a lot because of exports to the US and Europe, etc. So that should accelerate. And second is with corporates investing and corporate taxes coming down, they will spend more on IT. So that will be beneficial for our IT companies also. And DXY my view is that in the short term, because of all these changes, there has been a flow back to the US. So people are talking about outflows from India, but we should realize that it's not only outflows from India, it's outflows from many other markets going back to US. Okay, but that I don't think is very sustainable, and that's leading to the dollar strengthening. But beyond the point, dollar strengthening will again negate the impact of what Trump is trying to do. Strong dollar again makes America uncompetitive. So I think he'll not let the dollar strengthen beyond the point. And naturally also, as I said, the debt situation, internal and external debt situation in America is kind of increasing at an exponential rate. So they have no choice but to keep printing more and more dollars. And once you print more dollars, it means there's a cap on the strength of the dollar. So dollar will not appreciate beyond a point.
And we have a last question. For equity investors already holding adequate exposure, should we go lump sum or in tranches of 3-4 or STP route?
I mean, difficult question to answer because it depends on the investor case-to-case basis. But if you're already exposed quite a lot to equities, then maybe STP is a better route.
Thank you, Mihir. Any further questions? I request all the participants.
There's one more question, I think, last.
Yeah. If someone young investor wants to start investing for the first time, where he should go? Small, flexi, value funds.
I'd go for small and flexi because we're talking about young investors, so young people can take more risks. So I think small or flexi makes more sense.
So that is what all we have for today. Any further questions? I think there are no further questions. So thank you, Mihir. Thank you, Aakash. And thank you, everybody, for joining in. And we look forward for your participation in future as well. Thank you so much.
Thank you, Pooja. Thank you, everyone.
Yes.
Thank you. Good evening.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.